Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. Further to our recent video on discussing various LEAPS strategies, which could be helpful to first watch, there's a link in the card above if you've not yet seen it. But after reading all your feedback on our collaborative effort on researching different LEAP strategies, then I think I may have worked out mine. Also, if you'd like to discuss your LEAP strategy more in depth with me, you can do so on Patreon. I've heard a lot of great strategies from my viewers and tried to take them all on board, and I couldn't really fault them. Lots of different techniques work for different investors. This made me think that why is it necessary to stick to just one strategy? Now, just to be clear, to give you some idea of the level of risk I'm entertaining, it will only be a small fraction relative to the actual shares I hold. As in, to be clear, I am not using a large part of my wealth with LEAPS. And if I lost all of this money, it would not really affect my life in any major way. However, if it did work, it will affect my life a reasonable amount. For example, it would make me an additional profit to afford, well, just about every single Tesla vehicle there is, including the Roadster. But I'm playing with what I can afford to lose. We're all in different stages of our lives with different resources. Perhaps you can afford to play with more relative to your net worth because you have a high-paying job, or you have rich parents, or you're just young and winning a gamble this early on pays off that much more. As for me, I like the idea that I'm that much more involved with Tesla by controlling more shares. It's like betting on your favorite sports team in a game, except with LEAPS. Your team needs to win by 3 goals, hence the higher odds. Now, no one can predict what happens in the market, and clearly we may have potential macro issues to deal with. I mean, they are eventually inevitable, but the thing is, no one knows when. It may be next month, or it may be when Tesla has hit $10,000. For all we know, we could end up seeing the Roaring 20s 2.0, a century-old cycle or something. Hence why you should be careful. At the same time, Tesla could have increased its net profit 10 times within 2 years. Now, even in a hard-hit recession, I think this growth will still make Tesla drastically more valuable than it is today. Therefore, everyone is absolutely underestimating this company because it's too hard to believe. Okay, perhaps it might not be that high. Maybe that's only a 10% likely scenario, you might think. But if it occurred, then you get perhaps 20 times return on your investment. That's a good risk-reward return. But in addition to that, there could also be a 20% chance that you get perhaps 10 times your money, or a 50% chance that you get 4 times your money, and maybe a 20% chance of losing everything. So imagine it like rolling a dice. There may be one side that has lose it all, another side that has lose half, another side that has break even, another that has 4 times your money, another that has 10 times your money, and one that has 20 times your money. And when you buy a LEAPS contract, it's like rolling that dice. This is what an asymmetric investment is, and that's the game we are playing. Of course, those are just arbitrary numbers I am using, but when the stock dips, those percentages and potential returns increase. Do your own analysis and assign your own probabilities, of course. I've only been buying LEAPS on the big dips and have gotten lucky. However, sometimes it is hard to find the bottom of a dip, or even know if we're in a dip or not now. And right now is extra tough as we're about to have outstanding Q4 results and new factories open with the most coveted product for any Tesla fanboy, the 4680 batteries. Anyway, as for my actual LEAP strategy, it's very difficult right now to judge, as Tesla could jump up as high as $1,500 if the Q4 reports are even better than we think. And you have to wonder, is $1,000 a cheap price now? Will I kick myself for not buying them when they're so cheap? What was I thinking? Was I hoping they'd go down to 900 first, so I could make that little bit extra? Or is everyone worried that Tesla might crash into the 800s again and want to wait until then? Well, I think I may have made up my mind as to what to do. I think for starters, I will reduce my risk, or at least I feel this reduces my risk, by only buying LEAPS 2 years out, currently looking at January 2024. But the stock price would only need to increase about 40% from now until then in order to break even. Well, I say break even, but obviously there is the opportunity cost of not buying Tesla shares, which would have increased 40% also. So this figure might really be close to 60% increase if you include opportunity cost. But I might have a variety of different strike prices depending on what the stock price is. I think I may buy one about now with a strike price of $1,100. It is currently about $342, and then use a dollar cost average process, waiting for a further dip. And if it doesn't dip, well, at least I didn't miss out, and I will be selling shares in order to fund this. We're playing with options here, which means we can't take all the time in the world and simply hodl through events, as there is a ticking clock to expiry. Considering my main objective is to simply own as many Tesla shares as possible, my thoughts are that if over the next 2 years of holding these leaps, the stock price ever becomes something in the region of about 3 or 4 times my strike price, which would mean I could sell one leaps contract and use that profit to exercise 2 or 3 of them, then that will likely be my strategy. I know some of you like to roll the dice again and simply buy up more leaps each time, and have had great success in doing that. As for me, I think once I've accumulated these new shares, then I'll wait for a dip again and rinse and repeat this strategy, if I still think there is enough potential for Tesla's stock price to keep growing at these same rates, which there may very well be. If Tesla's stock price doesn't rise that much over the period, then I may just sell these leaps around expiration date and renew them again, as there is an eventual 5 to 10x return coming over the next 5 years, and it will sure be prudent to be holding some form of options when that occurs. You see, we're in exponential growth and have been this entire time, except the exponential growth we've been seeing most of this time, well, it's somewhat hidden, at least in the financials, as Tesla had been losing money for so long. It's kind of like a plant growing. It's been growing underground this whole time, and when it breaks even finally, then it comes through to the surface. Right now, Tesla is still just a little seedling, at least relative to its future growth. It still has yet to become a full tree. We know in any event that Tesla will need something like 20 times more batteries than they can make this year, including the 4680s they can produce themselves. We know that battery technology will only improve over this time, becoming lower cost, faster to produce, and more energy dense. Tesla will have better products, offering more value at a lower cost of production. This is going to continually happen, adding value to the product so people are willing to spend more on the product whilst reducing the cost through technology, of course, whilst also ramping up exponentially at the same time. Some people are concerned about the stock price going horizontal again, like it has in the past for so long. But through that period, Tesla was not making profits. It was hard to judge the value of the company for most people, as they just saw more and more losses. You can't exactly assign a PE ratio to losses. Now that Tesla are past that stage and making profits, then even in a down economy, it's hard to ignore profits doubling in a year, or likely shorter period. There are still PE ratios at play. Although I say this, I am anticipating a potential lull once the new factories have opened, due to margins reducing whilst the new production lines are ramping up. If this happens, don't let it catch you off guard, and of course, I will still be around to support you all, just like when the same thing happened last year. And in reality, I'm really only basing all this growth on the potential of Tesla's production numbers for their vehicles. There's still so much more to this company, and I believe in the end, the main profit is going to come from Tesla's software, which has barely begun. Can you imagine how much faster FSD will improve once Dojo is online? My thoughts are that it will simply take all the data that has been collected and should hopefully be able to come up with, I don't know, perhaps trillions of potential scenarios as a result, and program something there. I may be off by a few orders of magnitude or something, but you get the idea. Dojo can train itself. Just like Google's second version of AlphaGo trained itself and beat the previous version something like 100 games of Go to 0. AI moves incredibly exponential. Well, what do you think headlines like Tesla cracks full self-driving will do to the stock price? I repeat, what if Tesla actually cracks FSD, and maybe not this year, but if your leaps are far out enough, it increases your chances considerably. There are of course a plethora of other events that may occur over the next 2 years. The compact release, Tesla's LFP batteries, and even a humanoid robot. Not to mention the high probability of a stock split, which will make this leaps investing a lot easier. As I think you all agree with me, spending $30,000 or so on a contract is quite a bit of cash. A stock split will make that significantly cheaper. Again, let me know your thoughts in the comments below and we can further discuss this. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.